Christmas and New Year's come to much of the world, but war takes no holiday in the Middle East or in Eastern Europe. This is Bloomberg Wall Street Week. I'm David Weston. This week, special contributor Larry Summers of Harvard on why we didn't get that recession we expected this year.
I'm not terribly surprised that we haven't seen a recession in 2023.
Mary Lovely of the Peterson Institute on China's continuing economic struggle to rebound from the COVID lockdown.
The deep sense of malaise, we think, still lies within the population and within people's expectations for the future.
And Scott Bach of Greenhill on what's really going on at places like Penn and Harvard.
Donors are absolutely free to give to whatever organizations they want or not to, and to withhold for any reason they choose to, but they're not shareholders, so I don't think they should have a particularly loud voice in how a university is run.
Most of global Wall Street spent the week celebrating the holidays, taking a break from earnings reports and the Fed and the eco data. But there was no break for those waging war in Ukraine and in Gaza, as Ukrainian forces hit a Russian warship and shot down several fighter jets. And in the Middle East, Israeli forces continued to seek out Hamas militants, and Houthi rebels hit targets in the Red Sea, disrupting shipping in the region.
Half of all container ship fleets now currently no longer going through the Red Sea.
In the world of commerce, holiday shopping appeared to be holding up, showing that consumers still have some money to spend.
Unlike the last couple of holiday shopping seasons, we had to wait until the very last minute to see those consumer dollars flow through.
While Apple got a temporary reprieve of the ban on its watches as the Court of Appeals sorts out whether it infringed a patent covering sensors to monitor blood oxygen levels.
They have a stay until the US Customs makes a decision on a software fix that Apple submitted to the government.
Equity markets eked out another up week despite a bit of a sell-off on Friday as the S&P 500 gained just over 0.3% for the week, but that put it up a whopping 24% for the year as a whole, ending at 47.69. That's way above the median estimate of our Bloomberg L's for this year and only a bit under the estimate of 48.32 for the end of next year. The Nasdaq gained just over 0.1% this week, but was up over 43% for the year overall. It was a very different story for bonds, with the yield on the 10-year all over the place in 2023, but it ended up just about where it started a year ago, just under 3.9%. To take us through it all, welcome now Chris Ailman, Chief Investment Officer of CalSTRS. So, Chris, yeah, I have to say, you've put me to shame here, that dashing tuxedo, your black tie and your champagne. Boy, Happy New Year to you.
Well, apple cider, but that's okay. Happy New Year to you, David. And it really, it's a year that deserves a toast. I'm right there with Larry. I mean, I expected a recession, but we certainly didn't have one. And it's a spectacular year of double digits, 20%. Just amazing.
So what about it on the equity side, up over 20% or even up over 40% on the NASDAQ? How much of that was just the anticipation of Fed cuts?
Well, you know, it all happened in the last quarter of the year, because really, when you look at the equally weighted S&P 500, that was actually negative back at Halloween and then had a huge rally here at the end. It was really those 7 magnificent stocks. And on the NASDAQ, that really shows up. Best year since 99. Now, that's a lot to celebrate, but wait a minute. Think about 1999. For those of us that were in the market, you can't forget 2001, too. So it was a difficult time. We'll see how this carries through. But what an incredible year for equities. I was wrong. I predicted, David, that the markets would be down this year because, well, gee, the Fed raised interest rates 525%. Should have had a rough market. And let's be clear, the Fed hasn't eased rates, but the bond market has done it for them. You pointed out it's right back where it started the year, but my goodness, the long bond dropped almost 100 basis points since the Fed pivot. That's amazing in such a short period of time.
So what does that say to set up next year, 2024, for you? You have a lot of money at work. How are you taking a look at 2024? How are you positioning yourself?
Well, first, I'm celebrating because thanks to this market, all-time record high for our fund, $327 billion. But I have to tell you, there are certainly dark clouds on the horizon. I think the Fed has pulled off the soft landing, but we still have a lot of risks that we have to get through. And, you know, hope does triumph over experience. I know Larry Summers likes to say that it shouldn't, but sometimes it does. And right now, I'm hopeful. I think the Fed's pulled it off. But when you step back and look at this market, we've now created a double top in the S&P 500 in December of 21 and now in 23. As an old-time technician, that makes me a bit worried. That doesn't mean we should have a bear market, but I think a president's election cycle we know in history is at best a low single-digit return in the S&P 500. I would expect, like the elves, barely positive to some of our forecasts that we've looked at are slightly negative. So right now, people's expectations are certainly damped down into next year. I hope the public and the private markets finally open back up, because private equity and real estate really had a struggle last year. The markets were almost frozen. We're starting to see a few transactions, but certainly in the commercial office market, values are going to reprice down dramatically. And then in private equity, we're starting to see Merger Monday here in December. Every Monday, a few announcements. That's a good sign that maybe that market will open back up.
So, Chris, I don't want to look at the half-empty part of the glass. I want to continue the celebration you're having there. I endorse it. At the same time, what about inflation? We're so eager to get it behind us. Have we gotten it behind us? And are there some structural factors that might bring it back again?
I think so, David. I think, the Fed has said pretty much they're willing to accept 3%. And one of the first things I do every day is go on the Bloomberg and look at the commodities page and watch where oil is. Now, oil isn't the only driver of inflation, but it's an interesting signal. It's been pretty calm in the 60s and 70s in here. So I think inflation is going to stay where it is in the 3, probably won't get to 2, and Larry Summers can criticize that. But 3 is good enough for the Fed. But it's going to be sticky when I look long term over the next 10 and 20 years. I think we're going to see spots and spikes of inflation, mostly just due to climate change and disruptions. I mean, look at the Red Sea and the change there, the climate change issues for the Panama Canal. Those things affect shipping prices, and that's an inflation that's embedded well above 2, and the Fed has to decide what they can tolerate.
So, Chris, finally, given all those risks and opportunities, how do you position your fund?
Well, David, we're very neutral at this point to our asset allocation. Now, that means we're long growth, so we like this rally in the market, but we're really not comfortable at this point in taking a big overweight into equities. Non-U.S. was spectacular last year, also high 20% returns out of non-U.S. stocks. So last year was kind of a price to perfection, and this year looks a little tough. There are still 2 wars going on. Geopolitical risk is at an all-time high. I'll quote Larry Summers, the world's a dangerous place. And so that's got me concerned about taking a lot of excess risk. And I think that while we are at an all-time high, I have a tough time seeing this market having legs. The Magnificent Seven will do what they'll do, right, but I think even they've gotten ahead of themselves. And the bond market has overpriced, I think, that Fed rate cut. It's not as aggressive as they expect in March and May.
So, Chris, I'm going to let you get back to your celebration. It's really great to have you with us. Once again, Happy New Year, my friend. Great to have you with us.
Happy New Year, and to Wall Street Week. Thank you very much, David. Good to see you.
That's Chris Ailman of CalSTRS. Great to have you with us. And this is Wall Street Week on Bloomberg. Wall Street Week. I'm David Weston. And take us through this year that is now ending, 2023, and look forward to 2024. We welcome now our very special contributor here on Wall Street Week. He is Larry Summers of Harvard. So, Larry, thanks so much for being with us at the very end of the year here. Looking back at 2023, there was an issue about inflation, about how we could get it under control, what caused it. And Team Transitory, led perhaps by Paul Krugman, said it really was a supply chain thing. It would go away. You were more concerned about exactly the demand side and what the Fed needed to do. Looking back on it, which was right, what was wrong?
I think there's some of both. Look, to start with, we basically got an outcome that was closer to Team Transitory's prediction. Inflation came down with policy that is what their opponents were insisting on. Interest rates far beyond what they were recommending, far beyond what the Fed was predicting, as of almost any date in the recent past. So the record's a bit ambiguous. Yes, absolutely, there have been important supply elements. I have always stressed that we never were an 8% or a 7% inflation country, that because of bottlenecks, a variety of prices went up, adding to inflation, and they would then come down, subtracting from inflation. I'm not sure we're really a 2% target inflation country in any durable sense. I look, for example, at the 5.2% wage increase the federal government just gave, at strike activity that's more than it's been in a decade, at still tight labor markets, at potential geopolitical risks in commodity markets, at the fact that house prices have really started to turn back up. And I'm far from sure where we're going to go on inflation. So to declare that proverbial soft landing to have taken place seems to me to be premature. So I think we're still in an ambiguous situation. I've been saying, David, on your show for close to a year now, that there are three possibilities: that the economy turns down quickly, that the economy achieves the proverbial soft landing, and that in a sense we don't ever achieve a secure landing, and inflation never really gets down to target and even reaccelerates. And obviously we didn't see the hard landing in 2023. I was never as sure as many people were that that would come, because, as you also know, I've been arguing that neutral interest rates have gone up, so policy is not as contractionary as many people expect, and that the impact of interest rates are lower than many people have expected. So I'm not terribly surprised that we haven't seen a recession in 2023. And I think there are risks, looking at some of the credit figures for the next while. We may achieve that soft landing. I'd certainly say it looks better and more likely than it did 6 or 8 months ago. I always said that soft landings were the triumph of hope over experience, but occasionally hope may triumph over experience. And I think there's still a risk that the market is probably underestimating that we're not going to quite make as much progress on inflation.
So, Larry, we look at these questions not only because they're interesting historically, but to give us some direction for the future, where we should be headed. And so as you look at the risks as you describe them, what about the symmetry of them? Because some people are concerned that we have a bigger risk of a recession if we keep tight policy than we do of inflation running away. Where do you put the balance of the risk between recession by overly restrictive policy as opposed to letting inflation get ahead of us?
I think they're both very real risks. I'm a little surprised by the view that puts primary emphasis on the recession risk, given what's happened to financial conditions in the last 2 months. The stock market's taken off again. House prices are now rising at a 6 or 7% annual rate. Long-term interest rates and with them mortgage rates have come down substantially. I think that in a way we've already seen a substantial easing of financial conditions. And so I think we'd better be a bit careful with respect to the inflation prospect. And that continues to be a source of concern for me.
And finally, Larry, 2023 was a year of geopolitical strife. We started it with the war in Ukraine continuing. We added then the attack of Hamas on Israel and the difficulties that's raised in the Middle East for so many people. We have continued tension with China. As you look at the macroeconomics of 2024, how do geopolitics fit in?
The post-Cold War holiday from history is over. The world is once again a very dangerous place. with the prospect of war between major powers, the way in which the United States has conceived itself in terms of national security is no longer viable. We are going to have to invest substantially more in all aspects of national security. That ranges from increased defense spending well above current projections to thinking about national security issues as we think about our educational system, as we did after Sputnik, to thinking about our investment in connections all over the world.
Larry, thank you so much for being with us here at the end of the year, but thank you for all your contributions on Wall Street Week throughout the year. That is Larry Summers, our special contributor. He is, of course, from Harvard. Coming up, we expected a big rebound in the Chinese economy in 2023, and we didn't really get it. We talk with Mary Lovely of the Peterson Institute about what happened and what to expect in 2024.
We may, in fact, see depressed foreign investment into China for a good part of 2024.
That's next on Wall Street Week on Bloomberg. This is Wall Street Week. I'm David Weston. A year ago, China was emerging from its COVID lockdown, and just about everyone expected a sharp economic upturn. It didn't quite work out that way. To explain what happened and give us a sense of what's likely to come in the new year, we welcome back now Mary Lovely. She's Senior Fellow at the Peterson Institute for International Economics. Mary, great to have you with you, a true China expert. So give us a sense, first of all, what went wrong for China economically in 2023? Because it wasn't as good as people expected.
Well, I mean, in some sense, it had things that went wrong and things that went right. I mean, what went wrong, of course, is that an estimated 1.4 million people died from the quick spread of the virus through the economy, through the population. On the other hand, it did go through the country at very rapid pace, and recovery began before I think many of us expected that it would. The second quarter was particularly tough, high levels of unemployment, fall in industrial production, fall in consumption. But then probably by the middle of summer, they had basically hit the bottom and were beginning to bounce back. The bounce has been significant. They're on track to record about a 5 or 5.2% GDP growth for 2023. But a deep sense of malaise, we think, still lies within the population and within people's expectations for the future. And that looks ahead to 2024.
Mary, you refer to a general malaise going on. What can the government, what can President Xi Jinping do to address that malaise?
I think one of the main things that private businesses want is more clarity on how private businesses are going to be regulated and how the push toward economic securitization is going to impact their businesses. We saw the rollout of the counter-espionage rule this year. That gave a lot of businesses a pause. What kind of data could be transferred and to whom? It's very unclear what happens when one does transfer data that the government decides ex post should not have been transferred. I think the government has tried to clarify this, but part of the way Chinese legal system works is to allow for a significant amount of interpretation. And that means, from the point of view of businesses, vulnerabilities, ambiguities that raise uncertainty for them. It has a chilling effect.
What about the debt situation? We hear a lot about the debt borne, particularly by local governments, and there's some move for the national government to take over some of that debt, as I understand it. But there's a lot of debt overhang in China. Does that limit President Xi's options in dealing with the malaise?
Well, the central government has taken the unusual step of issuing bonds and then providing them to the local governments to spend. So I think the central government recognizes that local government finances are quite fragile. They have moved also to ask state banks to provide more credit for property developers, particularly to complete units which have already been purchased. What this does is it gives new cash to companies which may be unable to pay old loans, and it really begins to absorb that debt within the state banking system. So there's no question that some of this bad debt is going to be absorbed by the banks. That is, it's going to be socialized, it's going to be paid for ultimately by Chinese citizens. So there is this slow move to absorb some of this debt. But it does constrain local governments. Local governments can no longer use the methods that they've used to raise cash, that is selling property off to, taking property, amassing parcels, selling it to developers. That just isn't working anymore. And so what are they going to use not only to fund their local services, but also to continue their path of development? This is a big question, which has most economists, both inside and outside China, believing that China needs another major fiscal reform. The last major fiscal reform that really changed the relationship between central government and local governments and how taxes distributed among these different levels happened in 1994. So it's been a long time. The economy has changed dramatically, obviously, since then. And local governments need new revenue sources, but finding them is going to be difficult.
And finally, Mary, talk about foreign direct investment. Here on Wall Street, we pay a lot of attention to that. It certainly has fallen off rather dramatically. Is that important to President Xi as he looks at his economy? How material is that to him? Because a lot of things he says don't necessarily encourage people to invest. I mean, just this week, he's going back to Mao and saying that really he has a lot of ties to Mao and Chinese modernization, things like that. A lot of foreign investors don't hear that as being very encouraging.
Yeah, I think President Xi is largely speaking to a domestic audience. He was in San Francisco and had a dinner and made a speech to foreign businesses and investors. So he seems to, by his actions, believe that foreign investment remains important. Certainly in talking with Chinese economists, we hear the same thing. Foreign investment remains important, both as a source of new ideas, and to bring in, new parts of international value chains. But they have, the government has done things which clearly have had a chilling effect on foreign investment. Our latest finding is that not only has foreign investment into the country fallen, but that foreign investors are actually selling assets into China, something that we haven't seen before. Part of this is also external to China. It's the U.S. push to move supply chains away from China. So there's both a push and a pull factor here at work. I guess the question is whether we think that there's any big changes either in Chinese policy or U.S. policy, which are going to alter these forces in the year ahead.
Mary, thank you so very much. Really great to have you with us. That is Mary Lovely, Senior Fellow at the Peterson Institute. Coming up, the Hamas attack on Israel in October led to dramatic developments in the Middle East that spilled over onto college campuses in the United States. We'll talk with Scott Bach, the former chair of the University of Pennsylvania's Board of Trustees, about what happened at Penn and what we should learn from it.
But I don't think trustees should overreact in the situation of what could be a short-term crisis.
That's next on Wall Street Week on Bloomberg. Unrest on college campuses. In the aftermath of the Hamas attacks on Israel, American universities have been thrust into a national fight over lines between healthy debate and destructive invective. We've had major donors condemn administrations for tolerating cultures where some students no longer feel safe.
The underlying culture that permitted this to happen is just so strong. And until there is a moment of self-reflection where we're not dealing with just anti-Semitism, we're dealing with the culture that allowed this to happen, there really is going to be no progress. And to date, there's been no progress. This is really not a question of free speech. This is a question of favored speech and disfavored speech, and an institutional psychology and an institutional culture.
We've had college presidents called before Congress and asked to condemn calls for genocide.
I am asking, specifically calling for the genocide of Jews. Does that constitute bullying or harassment?
If it is directed and severe or pervasive, it is harassment.
So the answer is yes.
It is a context-dependent decision, Congresswoman.
It's a context-dependent decision. That's your testimony today. Calling for the genocide of Jews is depending upon the context. That is not bullying or harassment.
And we've had former college presidents insist that there's been a basic breakdown in who's responsible for what's going on in our academic communities.
I think for some years now, they have been substantially AWOL. AWOL as the climate of hypersensitivity has developed, AWOL as the relationship between the university and external communities has broken down.
Leaving us to yearn for a world where we can disagree, even strongly disagree, without deterring others from speaking out.
I suspect something will happen, but I don't know that Congress will do anything. I think the university boards are probably going to be more sensitive to these issues. There is going to be more security for certain students there for sure, but I think there'll be more of a move towards a University of Chicago approach where more people are allowed to say what they think without feeling that if they say something that's unpopular, they'll be criticized or harmed physically.
And to take us through what some of these disputes look like from the inside, we welcome now Scott Bach. He is chairman of Greenhill. Until recently, he was chair of the Board of Trustees of the University of Pennsylvania. Welcome to Wall Street Week. Really appreciate you being here, Scott. First of all, give us a sense from the inside, because you saw from the inside, what do you think has gone on and what should we learn from the experience?
Well, look, I think we've had a bit of a crisis on some of the leading elite universities in America in the last few months, and we haven't had one in a long time. It's really been a long period of quiet and progress at those schools, and so there are a number of questions that have been raised that haven't been raised in quite a while.
And what about the response to it? Are people a little rusty? I mean, I went to school back in the 70s when there was a lot of this going on. And in fact, administrations were used to dealing with demonstrations. Is part of the issue that, in fact, the administrations haven't been used to this? They sort of have to get the rule book back out.
I think that's exactly right. And frankly, trustees haven't given governance a thought in a very long period of time. You don't tend to think about governance when everything's going great, but when you have something that creates a controversy, suddenly people look back at that. And I think a lot of trustees, maybe have forgotten that the way universities are governed, that it's a combination of trustees, a president, and the administration, and also the faculty play an important role.
Well, we'll talk about that for a minute, about governance specifically, because we've had, for example, at Penn, but also at Harvard, other places, donors really speak out very forcefully, even make demands, as they would put it, about changes to be made. Back when I was practicing law, I know you did as well, we used to talk about a bad volleyball team where everybody goes to the same position. What are the respective positions, if it's done properly, of the trustees, the president administration, the faculty, and for that matter, donors? What should those positions be?
Look, I think to start with donors, I think donors are absolutely free to give to whatever organizations they want or not to, and to withhold for any reason they choose to, but they're not shareholders, so I don't think they should have a particularly loud voice in how a university is run. There is a governance system that's been in place for decades, if not centuries, in many cases, and that involves really trustees, the administration, and the faculty. Historically, trustees really focused on the financial viability of the organization. They did the budget. They reviewed the audit of the financials. They invested the endowment. They made sure that the entity was going to be viable for the long term, because these are meant to be perpetual institutions, of course. The president and the administration really run the business of the university day to day, and along with the faculty, they run all the academic affairs. And it's really been very rare, in my experience, really almost 2 decades, on a board of a university where the trustees get it all involved in academics. So I think they need to be careful about how much they reach into that area. And I know faculty are very concerned that they not reach too far into that area.
You mentioned two areas, academics on the one hand, finances on the other. Obviously, you're a prime example of somebody who's really, really knowledgeable in finance. It would make sense to have you on a board and indeed chair of a board. There is a third area, though, which I would call reputational risk. I mean, existential risk for the institution that maybe includes both academics and finances. But who should be responsible for that? And what sort of people do you need at the table making those decisions?
Well, I think clearly if it's an existential sort of threat, I mean, everybody needs to be involved in that. I don't think trustees can sort of seize control, nor can the president do whatever the president wants to do, or the faculty take charge either. It probably needs to be everybody involved in something like that. But I don't think trustees should overreact in the situation of what could be a short-term crisis and take too much control. It still needs to be a collaborative effort, because that is the peculiar nature of governance in these institutions. They're not public companies, and they really aren't run by like public companies historically.
By the way, there's another player that's gotten involved here, and that's the United States Congress, because the president of Pennsylvania, as well as Harvard and MIT, were called before Congress. What, if anything, is the proper role of the government in trying to influence the way this is handled on college campuses?
Well, I think the government has a very big role, of course, in public universities and a smaller role in private universities. But, you know, governments get involved in a lot of ways in any institution in American life. So you have to be ready to deal with congressional or other government inquiries when they come. And they do provide financial support to even the most private of universities in the sense of research funding and things like that. So they're going to have their legitimate questions from time to time. And those need to be answered. But fundamentally, the institutions we're talking about are private, and they're run fundamentally by the trustees, the administration of the university, and the faculty. And that's worked for a long time. I mean, I think it's important to remember, you know, elite universities in America are the envy of the world. I mean, people all over America go to great lengths to get into these places. People from all over the world do. You don't see a lot of kids from New York City trying to go to a foreign university to get their degree. You see a lot of them in Europe and Asia, Latin America, elsewhere, trying to come to America to get a degree because they see real value to that.
When problems develop in any large institution, that's corporations as well as colleges, I always ask myself, is it a substantive problem or is it a communications problem? And often it's a combination of the two. As you look back on what's happened at Penn, at Harvard, at MIT, how much of this is really a substantive underlying question of values and what the rules are, as opposed to not being clear enough on exactly where everybody is and what the rules should be?
I think it's probably a fairly substantive issue. I mean, communications is always a part of these things as well, but I think it's a fairly substantive issue. And I think the biggest factor, the biggest challenge really has been that we haven't had any sort of a crisis or controversy in quite a long time. I mean, you referred earlier to the 1960s. That's a long time ago, well before I went to school or you went to school. But, you know, there was a lot of unrest on campuses back then. And frankly, since then, it's been relatively quiet. I mean, there have not been that many controversies. There have not been that many moments when trustees asked about governance or what their role should be. There have not been many moments when I think faculty felt threatened by trustees and what role, or donors, and what role they might like to play. And so when something suddenly comes along, you know, everybody doesn't remember their role anymore because they haven't thought about their role in quite a while. Things just kind of hummed along quite nicely.
In the 1960s and into the 70s, part of what we saw on college campuses was a reflection more broadly of what's going on in society. I wonder if that's part of what we're seeing now, because generally across our society, there is more polarization. People are more outspoken. They're more actually coarse with one another in the nature of the discourse. And if that's right, what can campuses do? What can colleges do maybe to help us more broadly in society deal with some of these issues?
Look, I think that's a major factor here. We are in a more divided society, and the divisions tend to be quite deep, and people tend to see things in a black or white way. There's a lot of, and the voices you hear are on the extremes, right? You hear the extreme right, the extreme left. I do think it's important, and I've tried to convey in some of the comments I've made in recent days and weeks that, you know, what you see on social media, what you see maybe in a newspaper quote, what you see in a clip on television is a very small part of what actually happens on campus. I mean, as with anything else in life, the noisiest people get the most attention, right? So it's a small fraction of 1% of the people at these elite schools that are really actively involved in a way that anybody would find troubling. You know, 99% of those students are going about their business, trying to get a degree, trying to get into law school or med school or get a job at Goldman Sachs or Teach for America, and they're really not that involved in this. But yet you can get a sense from the outside, particularly if you're looking at Instagram or Facebook or just reading the tabloids or something, you're going to get a different view about what's happening on these campuses.
Scott, clearly you've thought through these issues a lot. You've been on the inside looking at them. You have a lot of very reasonable sounding thoughts about what should be done, what should not be done. Why'd you step down? Because you could still contribute to the solution, could you not?
I could certainly. I mean, I felt like our board got particularly divided at one point, and I felt like clearly there is a debate, and it's not just at Penn, it's a number of schools across America, about the role of trustees, faculty, and administration and managing universities. I think that's a very important debate. And frankly, I felt like I could contribute more to that debate from the outside than the inside. You know, if you're the chair of an institution that has, in our case, almost 50 trustees, you have to speak for that whole group. You have to be very, very careful what you say because you're speaking for the whole entity, a whole large group of trustees. If you're on the outside, you can speak more freely. And I think I have contributed, and hopefully even these comments here will help people understand that there's not a huge crisis. It's a small percent, very, very small percent of the students that are doing things that would be troubling for most people. Yes, there are things you can do about that, but we shouldn't fundamentally tear up, a governance model that's worked for a very, very long time and made our universities the envy of the world because of a very short-term crisis.
Scott, you certainly have helped me a lot understand from a really useful perspective what's going on. Thank you so much to Scott Bach. He is chairman of Greenhill. Coming up, U.S. markets may be on a roll, but much of the globe faces economic headwinds in the new year. We'll go through the issues with Janice Eberly of Northwestern's Kellogg School.
Monetary policy, we know acts slowly, it also acts cumulatively.
That's next on Wall Street Week on Bloomberg. This is Wall Street Week. I'm David Weston. U.S. markets are ending up the year on an up note, anticipating Federal Reserve rate cuts, slowing inflation, and continued economic growth. But there are at least some economists who are seeing some headwinds for the global economy overall. For her views on the economy in 2023 and what we're expecting in 2024, welcome back now Janice Eberly. She's professor of finance at the Northwestern Kellogg School. Professor, thanks so much for being back with us on Wall Street Week. Good to have you here.
My pleasure, David. Good to see you.
First of all, let's do a bit of a reprise on 2023. I would say as a non-economist looking back over it, we spent a lot of 2023 that felt like fighting against inflation in the United States, but more broadly. Have we largely put that behind us, do you think, as we go into 2024?
When we last spoke, we noted that in some cases, the past is not a great guide to the present. And the last few years have really been outside the data that we're used to seeing, especially in recent history over the post-war period. And 2023 is a great example of that. History was not a good guide to 2023. Some things really were different this time around. At least so far, that inflation-unemployment trade-off that people thought would require a severe recession in order to bring inflation down hasn't come to fruition. So the Fed tightened, as we all know, but the economy was very resilient, helped by strong balance sheets that made it less vulnerable to the big increase in rates. But that surprisingly strong demand doesn't bring inflation down. What it did was make room for a supply turnaround. And this is what's unusual relative to the historical record and the models that are calibrated to that data. Goods supply chains started to return to normal, worker immigration recovered, labor force participation, especially for those under age 55, really took off and hit a new peak in female labor force participation. So there's some good luck in those numbers, but there is also some inevitability in the sense that we knew that the supply chain effects were not transitory, but they also weren't permanent. And so the end of the pandemic wasn't to return to data as normal, but it started the process of unwinding the pandemic, which gave us supply tailwinds throughout 2023. And that's how you get stronger output without inflation, in fact, a disinflation, and maintained a strong labor market.
So take those two forces, if you would. On the one hand, restrictive monetary policy, which the Fed and other central banks, like the ECB, for example, have really pursued. On the one hand, on the other hand, supply chain reform on the other. And as I look at this, what do they say about the momentum going into 2024? Because on the one hand, you might think, well, these restrictive policies might well really curtail growth going into 2024. But if we really have a supply chain that's reformed, maybe we have prospects of good growth in 2024.
Well, there's momentum coming from the improvements on the supply side. So supply chain is part of it. And the metrics that we have on supply chain have mostly returned to normal. So that's probably not a continuing impulse, but it does sort of free up the economy to continue to expand. The other momentum comes from the labor market, where workers under 55 have really returned in record numbers. Immigration has been very strong. On the demand side, tight monetary policy, remember, has also been balanced by continuing strength in fiscal policy. So the CHIPS Act, the Inflation Reduction Act provided support for investment. And that will probably soften in 2024. So the concern for the adverse momentum is that the long-running increase in rates will finally have more of an impact. Because monetary policy, we know acts slowly, it also acts cumulatively, which we've seen in a number of markets. So that's the concern on the downside, at least in the U.S.
Professor, talking about growth in 2024, for many, many years, the globe has really relied substantially on China to drive growth, economic growth. China has not perhaps come back quite as fast as we thought it would when it released itself from those COVID restrictions. What do you think about China right now and its prospects for growth and helping the world actually in the coming year?
There's two areas that have been the focus so far. One is the property overhang, which has yet to work out, will take some time, and that's a big drag on the economy. There's also a fiscal drag coming from regional and local governments, which have developed a fiscal imbalance over time, which will also be a drag. I think in recovering or managing those shocks, there's a medium or longer run concern, which comes from the increasing centralization and focus of the business economy and the changing business environment and restrictions that have been put in place. It's always difficult for an economy to transition from catching up and growth into being a global leader that is moving from technological adoption to technological innovation and leadership. So that's always difficult. But having headwinds coming from governance and from institutions will make that even more difficult. So I think a thing to keep an eye on in the medium run is what is the central interaction, the central government interaction with the business community, any restrictions that are put in place, in particular on individuals and on the movement of people and goods and capital.
We talked earlier about supply chains and how the release of the supply chains has helped the United States, the Western European economies, the Western economies, if I could. What about supply chains when it comes to China? Because it appears there's been some reformation of supply chains, maybe pulling back some from China, and maybe going to some places like India or Southeast Asia or even Mexico. As we go into 2024, do you see potential for resurgence and growth in some of those areas?
There's definitely been a movement of some parts of the manufacturing chain into other countries and diversifying that part away from China. But there's been some recent work digging into the data further, and you still see China as a supplier of manufactured goods to those other links in the chain. So it's not as if China has moved out of the supply chain. They just maybe Occupy. They've moved up and down the supply chain, in particular up the supply chain, and to become suppliers to other manufacturers. So they still play a very important role, which will help their economy, help them to remain stronger. And then you see this diversification moving down the supply chain, which will help other countries in Southeast Asia in particular, but also Mexico, for example.
Professor, great to have you back on Wall Street Week. Thank you very much. Appreciate your being here. That is Professor Janice Eberly of Northwestern's Kellogg School. Coming up, does crime have its own internal rate of return? That's next on Wall Street Week on Bloomberg. Finally, one more thought. Back in 1860, the UK Law magazine wrote that crime does not pay, saying that the benefit of prison was providing time to reflect on that basic maxim. And through much of history, it seems to have been true. After all, Charles Ponzi did end up in prison for that scheme named after him, as did Jordan Belfort, the famous Wolf of Wall Street.
The real question is this: was all this legal? Absolutely not.
Though Belfort did have a second act after prison, writing successful books about his experiences and giving motivational speeches. Bernie Madoff had no second act. After being found guilty of masterminding the biggest financial fraud in history, he was sentenced to 150 years in prison and spent the rest of his life there.
If you did utilize the fictional statements that Mr. Madoff was creating, you would be in effect reinforcing the fraud, letting the fraudster decide the outcome, which certainly would be far from fair under any circumstances.
But they say the exception proves the rule. And this week, Global Wall Street got what appears to be a big exception to the rule about crime not paying. This was the year that Changpeng Zhao, or CZ, as his friends call him, pleaded guilty to a host of federal criminal charges for the way he ran Binance, the largest crypto exchange in the world.
The message here should be clear. Using new technology to break the law does not make you a disruptor. It makes you a criminal.
CZ faces sentencing in the coming year, but now Bloomberg reports that despite his legal problems, Mr. Zhao increased his wealth this year by a cool $25 billion, which on its face looks like a pretty good return on some pretty bad behavior. And in the new year, we all may get to look at this crime-paying question from a very different perspective. We've all heard repeatedly about the 91 criminal counts pending against former President Donald Trump in 4 different prosecutions.
My message is simple. No matter how powerful you are, no matter how much money you think you may have, no one is above the law. And it is my responsibility and my duty and my job to enforce it.
Under U.S. law, we presume all defendants are innocent until proven guilty, and Mr. Trump is certainly no exception. At this point, it's far from clear whether or when any of these accusations will even make it to a jury. And by that time, he could well be president once again.
Thank you.
But in the meantime, it appears that even the act of charging him with crimes may be paying off, at least when it comes to fundraising.
Every single time there's a court date, every single time this piles on, every single time that he has to go and spend his fundraising money on legal defense.
That does it for this episode of Wall Street Week. I'm David Weston. This is Bloomberg. See you next week and next year.